Hey everybody, Jeff Gibby here. I hope you're doing well. Welcome to Market Recap. We have a great guest today. I'm very excited about it. And as you can see, we're going to go ahead and start with our legal disclaimer. So today's demonstration is designed to instruct you on using Metastock, the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So hope you enjoyed that. We do have a great guest today. I'm actually really excited. You know, we've got a little bit of a volatile market, and somebody that I very, very much respect in terms of their opinion about what's going on, what they think is going to happen in the future. You know, kind of, I'm interested to really hear what Vince Vora has to say. So Vince, just to give you a little bit of an introduction to him, he runs of course, my phone would start ringing right now. He runs a company called TradingWinds.com, and we've been partners for, I'm going to guess, to made about 6 or 7 years. We've developed some of our most popular add-ons with him. One of the things that I've always respected about Vince is he's very, very personable. He's very, very thorough, and he's also made me personally code some of the best Metastock code I've ever produced with his with some of the add-ons that I've helped him write over the years. So, like I said, I really respect him. I'm really looking forward to seeing what he has to say about the market and kind of what he thinks is going to happen going ahead. So, Vince, let's go ahead and bring you on here. How are you doing?
I'm doing well, thanks. Thanks for having me on.
Yeah, absolutely. I'm going to go ahead and make you the presenter.
Okay.
So, you know, you might have heard, I don't know, there was a little bit of a market correction a couple of weeks ago.
Yeah, oops, 1 second. Let me try to get my camera straight here. There we go. You should be seeing my Metastock chart.
I can see it.
Okay, let me see if I can open my camera to you here and see what that looks like.
Oh, you're wearing glasses. I'm not used to you wearing glasses.
Age is catching up for me now. I've got to, if I want to see the charts, I need to wear them. But
I've had to wear glasses since a very young age. I remember asking one of my elementary school teachers why she wrote on a chalkboard.
Right.
And I ended up at the eye doctor right afterwards. So anyway. Yeah, okay, here we're looking at the Dow, I think.
It's the S&P. It's the S&P 500 here, and you're right. It's been a very, very interesting market. I'm almost a little surprised where we're at, how far we've bounced back, but it's from a technical perspective, it's actually a very orderly retracement right now. And you know, if it wasn't for the stimulus package and how determined the government is to keep this economy going, I'd really be expecting a very violent sell-off from here. Having said that, I mean, I still believe we are going to sell off from here. It just makes a lot of sense. But you know, I'm not as confident as I was when we started this whole, you know, coronavirus lockdown issue.
Yeah, I remember talking to you right around when it was happening, and you were like very, very, very bearish. You're probably one of the people that were right. So, do you think we're taking a test lows, or do you think we're going to set new lows? If you had to make a guess.
I would expect to at least retest, but I think we're going much lower. I will actually show you what my original prediction was. And like I said, if it wasn't for the stimulus package, I think we would easily hit it. Now I'm not as confident, but still believe that the economy is going to struggle very much so. Even though I believe we're opening, or they're planning to open the economy sooner than I had expected, I think that could actually work against them. I think without the proper testing and so on, if there's another ramp up in cases and more deaths, and we have to scale back again, I think that's going to be even worse. But just to show you on a technical level, I mean, I've been bearish for a while on these markets, even before the whole coronavirus thing came into effect. I thought the bull market was overdone. And with the debt levels where they were, you know, and all the stimulus that we had come up with in 2008, 2009, I thought we were due for a pullback, and I thought it was going to be a big one. What coronavirus has done is really escalate the timeline and the severity of the impact on the economy. I mean, we've seen the jobless claims over the past month reach
Ridiculous.
what, 22 million so far.
Yeah.
You know, so I think, you know, and I don't think that's all of them just yet. Now, certainly when we open up, some people are going to be going back to work, but I don't think everyone will be going back to work. And I think we're going to have double-digit unemployment going forward. And we can talk a bit more about it, but I think the level of stimulus in the long run will really devalue the dollar and put more pressure on this market. So I think originally I was expecting a pullback into this area here, into about 210 or so. This is the SPY, so it'd be 2100 on the S&P 500, but I was expecting something around the 210 area, and we almost got there on the first leg lower. Eventually, though, I was thinking we would come all the way back down to about the 1500 level on the S&P, and I still think we can get there because of the lack of support is below here. So now, you know, if we go back to the daily chart here, I've been watching this because we are, where is it here? Fibonacci retracement tool. We have been retracing, and we're right back into sort of what I call the sweet spot here between 38.2 and 61.8. That's the zone of resistance that I look for any turnaround. Now we've busted through the 38, we've gone through the 50. Now we're headed towards the 61.8, and so I think we can get there. But that, if we extend that out to the left of our chart, we can see that that lines up with much more serious overhead resistance. And so, I think we could be in for a bit more room higher here, and then an eventual retest of these lows. Now, what's going to be important is on this pullback here, can we manage to put in a higher pivot low and then break the high and move off to the new highs? If not, if we break through this low, I think absolutely we will test the 210-ish area, 220-ish, and then potentially make our way down to the 1500 level. So again, I think the stimulus package has resulted in a much bigger retracement here than we would have otherwise had. I honestly thought back here that we were going to retest those lows. What's interesting, though, is there's a real divide between the Dow, the S&P, the NASDAQ, and the Russell, the four main U.S. equity indices. The Dow and the S&P look very similar with these levels. The NASDAQ has actually, and I'll use the Qs here, QQQ, the ETF. If we look at the Fibonacci retracement here, we've already moved above that 61.8 mark. So this is sort of ahead of the game, and that has a lot to do with obviously Amazon, Netflix, Microsoft, some of those monster stocks that are doing quite well. But then again, you look at the Russell, I'll use IWM, the ETF, and we're sort of behind the curve with this one. I think we've gotten to the 38.2 level. Yeah, we're just there, and so far pulled back. Haven't been able to make our way above there yet. So we're not ready to pull back just yet. We've got to wait for confirmation. But to answer your question, yes, I do believe we're going lower from here.
Now, you talked a little bit about timeline in terms of opening up the economy and that kind of stuff.
Mhm.
What is your gut feel for? Are you thinking that like we're going to actually be able to open up this economy on May 1st? Is that kind of a scenario that you're playing with?
No, I don't think so. In fact, if it was up to me, I'd keep it closed much longer. I think the risk we're taking with having more people contract this awful virus and it's spreading even more once we reopen is a real risk to the economy. I'd rather keep it closed an extra month and make sure that the number of cases are very, very low at that point before we ramp up.
Hmm.
Um, at least until we have some sort of
Testing.
testing, a vaccine, which seems to be a while away right now, or some other medication that would help. I know there's a number of pharma companies working on this stuff, but we're not quite there yet. So I think it's a bigger risk opening up earlier, but it's up to each governor and each state. And so I think some will open up right away, and others will not. But I fear what happened in New York could happen in other states. And so I'd personally rather not see the economy open right away.
Yeah, I think personally, I feel like the best kind of open date would be towards the end of May or even the
Exactly.
beginning of June.
That's right.
But are you thinking that we'll end up opening up maybe in May then with the
I
scenarios
think
that we're talking about?
yeah, I think it'll be spread out from state to state. I think it'll sort of phase in, but I
Yeah.
do think we will certainly see some states reopen even before May and others slowly throughout the month of May. I think in the end, what we're talking about here is where exactly is the unemployment rate going to land? I think that's not clear right now. Certainly with everything shutting down at once,
Mhm.
we had millions and millions of jobless claims being filed. Some of those jobs will come back. Others will not. There are many businesses that will not have survived this past month or so, will never reopen. Some will reopen, but
It's
will
how
most
fast we
likely
can
not.
get people to work, right? Once it opens up.
Right. And so think of restaurants, right? They may have been able to get by for this month or two, but when they reopen, how busy will they be? How many people will actually feel comfortable enough to go sit in a room of 100, 150 people to have dinner, right? It really depends on how comfortable people will be. Will people be going back to theaters to sit shoulder to shoulder to watch a movie or go to a sporting event? And if not, then not all the jobs are coming back. So if we have a double-digit unemployment rate, I think when we actually experience it, when we actually are open for business, but can really get a handle on what an impact this has had on the overall economy, then I think we'll get a much more realistic picture of where the market should be at that point.
Okay. That's a good assessment. What do you think is okay, let's just talk a little bit about let's say that in a hypothetical scenario, I'm a long-term investor
Mhm.
and I see all these stocks that are potentially on sale right now, and
Right.
maybe I have some dry powder and I've been picking up some stocks. I mean, just hypothetically, right? But
Absolutely.
do you think it's a good time to buy for the long term, or do you think it's better to wait and see kind of how whole things come down?
I, I think it's a good time to start nibbling. I wouldn't buy my full position,
Hmm.
but I would start to buy here because there is a chance that we may never test these lows. If we do say hit the 61.8 retracement level and then start to make our way lower, who knows if we're going to hear of more stimulus coming in and so on. So there is that chance we may never retest those lows. So I think it is a good idea to start to nibble. I think the main thing is, how do we go about that? So I can tell you how I do it myself at this point. I certainly would not just buy stock and hold the stock. I think there's too much exposure there. number one, I think you got to look for solid companies that have very little debt on the books, that pay a healthy dividend and have a good track record of not only paying dividends but increasing that dividend over the years. So, I'm talking about the Procter and Gamble's, the Johnson and Johnson type companies. I think that's what you would focus on right now. But I wouldn't feel comfortable just holding those stocks. What I would do is marry a put to it so that I'm locking in a very small amount of risk. But I would do so with leaps at this point. That way, I'm giving myself plenty of time for the stock to appreciate in value. In doing so, that dividend that I would collect over those next couple of years would pretty much cover the cost of the put to begin with. And so it's allowing me to hold on to what I think would be a great stock, have plenty of time for it to get back to the highs and then some, and risk really very little because of how I would structure it with that put. And I can show you an example.
Yeah, let's look at it.
If you want. So Johnson and Johnson, if we look at Johnson and Johnson here.
I actually looked at this one today. And I was amazed that I actually looked at this one already today. But go ahead.
Yeah. And so with our veracity system, we did get a buy-in here several days ago. But when we're talking about, buying this for the long term, it's not the daily chart I'm interested in. It's more the weekly or the monthly. And when I look at J&J, we have triggered here on the weekly as well. And we're right near the highs, right near the absolute highs. And so there's a couple of things I look at. Number one, if we look at this channel, because we can mark the highs here of this range on the weekly, and the lows, and look at how long we've actually been in this channel. I'll just draw it roughly here. So going back to the start of 2018, so pretty much 2 years. So from a technical analysis perspective, we can look at this and say, hey, we want to measure that channel. And when we break out, what we should expect is a move similar in length to this channel, which means we've got basically 2 years of upside here. And so what I would look at is, let me bring in my option chain. And what I would do is go out to the Jan 2022 option chain here and look for a put here that would offer me some protection, but offer me plenty of room for upside. So I'm going to go, I could do one of two things. I can go in the money where I have a lot less risk, but a much smaller net delta. Instead, I prefer to go out of the money. And what I'm going to look at here is, say, the 110. Okay, actually, sorry, this is P&G here on the option chain. Let me switch that over to J&J. There we go. So J&J finished the day at $152. You can see up here. So let's go look at Jan 2022. And I'm going to go out to, say, the 110 strike, costing me roughly $7. That was the last trade, $7.20, more or less. Now that the market's closed, the spread has widened, but it was much tighter earlier in the day. So if I pick up the stock at 152 and I'm buying the option for another $7, let's say, for easy math, that's $159 total cost. All right. Now, you may look at this and say, well, you have an out at 110, but your cost is 159. That's $49 of risk. I'm not really comfortable with that. But I'll show you why you really don't have to worry much about that. Number one, over the 2 years, if you do hold this to 2 years, the dividend alone, which I think they're paying a dividend of about $3.80 a year, if I'm not mistaken, about 2.7% or so. So if you collect a couple of years of dividend, it'll pretty much cover the cost of that put. That's one thing. But what this does is give you a big net delta. So as the stock moves higher, more than 80% of the net move will be profit for you. Now, if it goes higher, the put will drop and eventually be worthless, but you don't care about that because you're making plenty of profit on the upside. Plus, you're collecting that dividend that paid for the put in the first place. If the stock drops, then the put actually gains in value. Now, the advantage of having the out of the money put here is that it's all time value. So if at any point in time, you go back to the chart, let's say, and we say, well, it turned around on us, and now it's at a level where, we would hold a stop and it's stopping us out. So in other words, the chart is telling us we should sell this. Well, sorry about that. Let me go back to the option chain. What you do is you swap this long-term leap for a near-term option, and you suck all that time value out of it. So let me give you an example. If we were to sell this 110 put today for $7, let's say, and we take that same $7 that we spent, and let's say we go to the third week of May, okay? Now, what can $7 buy us if we look at this? So that takes us all the way up to, well, about 152.50 or 155, in that range. See, the 155 is 675 to 940, in that range. So by swapping that out and taking out all the time value out of that option, I'm able to move my strike up actually to above where I bought the stock, to 155. Now remember, our total cost was 159. I can get out of this at 155 just by making that one adjustment. Yes, I'll be taking a $4 loss, but it's nowhere near a $49 loss that I had set up in the first place. Now, we can go a step further and say we can sell a call against it at the same strike and pick up, 3 and change. So our loss is actually very, very small in doing this, when our upside is really unlimited, right? Because the dividend pays for the put, the delta on the stock is extremely high, and we have nothing but time. We have 2 years in time. So that's the way I would start to nibble on stocks in this market, where I'm taking a very, very small amount of risk if the scenario that I'm actually anticipating to happen, which is to the downside, actually happens. But if I'm wrong, then I'm in that play, and I'll be rewarded for it over the next 2 years.
Awesome. Do you have an opinion on, let's say, Amazon is a pretty hot instrument that people are looking at these days?
Yes, I love Amazon. We just had a trigger on this a day or two ago, and pretty much participated in that full move here. That's the weekly. Let me go back to daily. There it is. There's the actual entry just above the 2,000 mark, and we're at 2,400. But I love the company. I mean, obviously with the shutdown, they've had a lot more online orders, are hiring, I think 75,000 new employees, et cetera. They're obviously doing well and making money. But having said that, there's no way I would chase it. I would not buy it up at these levels. Sure. I'd wait for it to settle down, hopefully to come back into support here, right? About a 50% retracement from where we got in here. We moved up about 400 points over the last few days. If we come back 200 to the 2,200 level, that would be a beautiful spot for this to settle down in, and then bounce from there. And at that point, I'd be willing to take a flyer on it. And first target would be the highs here. But obviously, this is an all-time high. There's no resistance up ahead. There's plenty of momentum behind this. So that would just be the first target. And then, I'd probably use my Fibonacci extension tool to identify further targets north of 2450 here.
Are you ready for a couple YouTube questions?
Absolutely. Sure.
All right. So Anis Ahmed says, NFLX, Amazon have already made all-time highs after the meltdown. Do you think they are leading the markets, or is it a dead cat bounce this time?
I think they're definitely leading the NASDAQ 100. I still have a hard time believing that this market can just go right back to the previous highs and then some, and basically start off another bull run, considering the state of the economy that we're going to experience when we all are able to leave our homes. I mean, I'm sorry, but with a double-digit unemployment rate, which I think is where we're going to land at the end of this, it's going to be devastating to the economy. I think it's going to have an effect on the real estate market. It's going to affect everything. I mean, think of it this way. We what did we have before all this started? An unemployment rate of 3.5, 3.6%, I think.
Mm-hmm.
And it wasn't all just roses. I mean, there were still homeless people. There were still people living paycheck by paycheck and suffering. I think one of the things that doesn't get talked enough about is the wage gap in this country. I think over the years we've created a bigger and bigger wage gap. We've headed more towards a third world country where you see, no middle class. There's either, a segment of the population that is very poor and a segment that is very well off, with very, very small numbers in the middle section there. And so
we've only been working on that since the 70s, Vince.
Yeah, I know, but recently it's winding even more, and I think what we're going through now makes that even worse. So I think, and you don't get a lift in the economy from the very wealthy group putting money into the economy, because the numbers are so small there. Yes, they're spending a lot, but it's a handful, right, compared to the masses down below. So really what we need to boost the economy is help that lower class segment move up into the middle class and build that middle class. But this situation here has really, really hurt that and really set us back. And so I think, many of us are going to struggle coming out of this. And I think it's going to be a very slow recovery. So I still have a hard time believing we're going to see a V-shape recovery.
He also asked, do you completely rely on fibs to predict markets going down?
No, fibs they're just one tool that I use. I do rely strictly on technical analysis. I'll be honest. I don't look at fundamentals. I only look at technicals. So it's great. Yes, it's great and it feels good to be able to buy a company that has been around, seemingly forever, like a J&J or P&G, that is solid, doesn't have a lot of debt, etc. Of course, you could mix the two, fundamental and technical analysis, but myself, I rely strictly on technicals. And one thing that I always tell my students is, you don't need to know why. If you're the type of trader that asks why something is happening, for example, why is Tesla going higher, right? If you're trying to figure that out, looking for the real answer, you're setting yourself up for losses. So trying to make sense of why the S&P is going up when the economy is pretty much shut down, it will drive you crazy. There's so many factors that affect it that there's no way one of us can figure that out. So I always say, as long as you know what is happening, and with technical analysis, the price action will tell you exactly what's happening. So if I go back to the chart of the S&P, the SPYs, what's happening here is that there's more buyers than sellers, plain and simple. And price action will tell you that. Now, tools like the moving averages, tools like the Fibonacci extension, the retracement tool, will help you navigate your way through a chart and will help you make a decision as to where the market may turn at some points. But in the end, those are just tools. The actual price action is what matters and really what tells the full story.
Well said. Well said. Black Hole says, surprisingly, some stocks are benefiting from Corona, such as Zoom. And I think that's actually a pretty good point. Do you see any stocks out there that are currently good opportunities to buy because we currently have the situation we're in?
I think the ones you see right now, I mean, obviously they're not at a price level that everyone can participate, like the Amazon, the Netflix of the world. Zoom is one, Clorox, Procter and Gamble. Those make a lot of sense. And those are the ones that I would stick with. Now, to do what I had explained earlier, obviously you need enough capital in your account to own the stock and the options. But if you don't yet, you can either buy a handful of shares of the stock alone. Yes, you'd be taking more risk if it turns against you, or a single option contract as well, until you can afford at least 100 shares of the stock that you compare one option contract with. But yeah, I think, if you just take an index like the NASDAQ 100, for example, and go through those 100 charts one by one, it'll be clear to you by the price action which ones are benefiting from this environment and which ones are paying a hefty price for it. There's only a handful out there that are doing well, but they do exist. And so many of the ones we've mentioned are very good candidates.
Let's see, we had one more. Rosemary was kind of talking, this was during your example of, I think it was J&J, where we were looking at buying the put option. She wanted to know, do you collect dividends on LEAP options that you're holding? And
no, sorry, go ahead.
Yeah. No, I wanted to give you an opportunity to kind of explain that a little bit more fully.
Sure. No, options, if you just own an option, whether it's a call or a put on a single security, you will not be eligible to collect the dividend. The dividend is only paid out to the shareholders, the ones that actually own the shares of that underlying stock. So you have to purchase Johnson & Johnson shares to receive the dividend. But if you simply don't have an account big enough to own those shares, then purchasing the option, it really, to me, I almost exclusively trade options because they're a great vehicle. They allow you to limit your risk, because when you buy an option, say you buy a call option for $3, okay, the sky's the limit. There's nothing preventing that contract from appreciating, but all you can lose are the $3 per share that you put in it, right? Each option contract is the equivalent of 100 shares. So if you pay $3 for a call option and you buy one contract, you're spending $300. But even, let's say, everything goes horribly bad for you, and you had bought a call option here and the market ends up down here and your option is worthless, the only thing you lose is the $300, nothing more. But if we were to get back to the highs with that contract, that could be worth several thousand. So the risk to reward on options is fantastic. And the more you learn about option trading, the more you can pair them with stocks or do spreads, butterflies, many different strategies that you can take advantage of, where you have very small risk with almost unlimited reward.
I agree. I love options.
Yeah.
That's kind of the end of the questions. Let me just ask you, what are you watching for in terms of getting cues out of the market? Like, what are you going to be watching for to happen, let's say next week, or even the week after that, in the near term future, to kind of confirm that we're going down, or confirm that maybe this is a V-shaped recovery? What are your cues going to be for that?
Sure. So aside from our veracity for trades in and out, what I like to do is stick to basics, which are higher highs and higher lows, and look at levels of support and resistance. So if we take a look at the S&P here, ever since we rolled over here and moved below the 20-period moving average, at that point, right when we broke this level here, we had put in a low at that point. And then after retracing here, right here, we put in a lower high. So at this point, we had a lower low and a lower high. And so we had made that shift from higher lows and higher highs to lower lows and lower highs. We knew at this point things were going south. We didn't know how far, you never do, but we knew that was the turning point. Now, what we've done is made the shift in the opposite direction. We now have a higher low, and since we broke this level, we have a higher high. So we're back to moving higher here. The main thing I'm looking at is this level of congestion right in here. Here, this zone right in here. So obviously when price gets to this level and it's pretty much there, it's like running into a wall, right? So on the way down here, it was support. And if you can look, it bounced right off this area. It came down here and bounced. It didn't make it through there on the first attempt. But on the second attempt, when it broke it, that's when the acceleration happened. Because if we look to the left, there was no other support area here until we got down here, which we can see on the weekly or the monthly. But now, what was support turns into resistance. And so it'll be interesting to see if the market can get above that overhead resistance. And if it does, if we can get above the upper highs, the highs that make up the upper trend line on this area, which come in around 300 here on the SPY or 3,000 on the S&P 500. If we can get above there, I'd be comfortable in saying we're not only going back to the highs, we're going even higher. But until that happens, I'm looking for any bearish sign of a rollover here, any sign of a rollover. And, you know, the one thing to look for is not just, you know, a few bars that point lower, but you have to take out some kind of low. And taking out a significant low really sort of confirms it. But an initial low, taking out an initial low is the warning sign that, hey, we've probably started our descent to retest these lows. So that's what I'm looking for.
Okay, more questions. I'm taking a few long trades in US 30 cash. Do you recommend I hold them, or do you think the Dow will continue to rise?
I'm sorry, I didn't hear what the position was in.
US 30 cash.
I think there's, you know, I think there's more upside there right now. I wouldn't be in a great hurry to get out of that right now. But again, you know, I would look at it from day to day and follow that price action. But I think right now there's more upside there, and then eventually things will switch. You know, you look at the dollar right now. Before we sign off, just wanted to touch on that. I mean, I'm happy to stay as long as you want, but I want to make sure we get the dollar in.
Sure.
The dollar, and let's see, let's bring up the dollar index here. You know, is that another critical level here where it could kind of go either way? Now, I still think that there's more upside here for the dollar near term, but longer term, with all the stimulus and so on, devaluing the dollar, I think there will come a time where we'll see a sharp decline in it, which even longer term, I think will be beneficial. I think that's what we need to repair the economy when everything is said and done, because with a drop in the dollar, that's the only real way to get the manufacturing sector coming back to life. But I think that's many months away. So for now, I would expect the dollar to hang in there, but eventually fold as well. But this is one chart that you want to keep on your watch list and want to look for cues. But there's one more market, Jeff, that I'd like to talk about, and that is crude. That is crude. With crude below $20, I really don't understand how this market is where it is. In other words, with such little demand for crude, which makes sense because who's out there driving, what business is running. There's no demand right now for oil. Oil is a great predictor of the economy, right? A great way to gauge the economy. And so with such small demand, and even with those production cuts we saw from OPEC last week, we're sitting below 20 on oil. I don't understand how the markets, the equity markets are where they are. So crude is another reason why I think we're going to see a pullback in the equity markets.
Interesting. Do you have an opinion on Tesla? Sadish wants to know.
On Tesla? Tesla's another mystery to me. I mean, it is what it is. You follow the price action and you follow the signals and, go with it. Because again, you don't want to ask why, you want to ask what's happening and go with it. There's another potential setup here right now that could trigger as early as Monday. Now, weekly, we've triggered, we're on our way. And again, from a technical perspective, when I look at this, I see very little overhead resistance. I see plenty of momentum. And obviously buyers are in control. So I would say we should move higher here. Nice big bullish engulfing pattern on the monthly so far, gaining momentum. But ever since we broke above these highs, we've taken off. When I think of the company itself and the struggle it should face with the downturn in the economy, I really struggle to make sense of this price level. I really do. But again, I think I've been trading with technicals long enough to know that my opinion or what I think matters very little. It's what you see on the chart that matters, and this is telling us we're going higher.
It's definitely just means there's more buyers than sellers.
That's right.
That's right. Oh, here's a question you like. Do you have any options training videos?
Oh yes.
Yeah, and Charles both want to know. So if somebody wants to, I do think you've done a couple courses around just trading options on tradingwins.com, correct?
Yeah, absolutely.
Yeah, and I'd recommend them. I mean, one of the things that Vince, how long have we known each other?
Oh,
a little bit, just a little bit, right?
Yeah. It's been a while.
Vince has just such a good way of kind of taking complex. I would recommend his training. I'll just he does a good job with it for sure.
Yeah, I'll before we go, I'll put up the just a quick slide with our contact information. So if you want to know more about that, you can give us a call or email us.
Okay, and let's see. American Retirement and Investment Strategies totally agrees with you on the pullback of oil at this level. Mm-hmm. So there you go. And Charles says he's very interested in your options training as well. So definitely, I don't know if you have anything else you want to look at. I thought this was great. I don't have anything else.
No, thanks for having me on. I'll let me post this up here. Let me just switch the slide. There we go. On our website, you'll see if you go to the store, there's a number of courses, but I'll tell you what, if you want to email us here, for anyone that emails us and requests more information, what I'll do is I'll get my staff to send you our introductory course on options, our basic option course. For free. We'll send that out to you. Okay, so just send us an email at info@tradingwins.com and just refer to this event and ask for that introductory options course, and I'll be happy to send you a copy.
That's very nice. Do you want one last question?
Sure, absolutely.
American Retirement wants to say, how long will the stock market pullback go, and how long do you think it'll take?
Again, I thought it was going to be around a 2-year pullback. Now, with the whole coronavirus event, I think the market crashed. At least the first leg happened much quicker than what we were expecting. So it's kind of shortened the timeline that way. But I actually think that because of the coronavirus, the economy will struggle for much longer. So I don't think we'll, barring any major, stimulus move that just sort of, I don't want to say falsely props up the market, but use whatever words you want. I think barring any of that, I think we're going to be in a bear market into next year for sure. And then we could start to recover from there, even though I think the economy is going to take well over 2 years to get back to these levels. I think it'll be quite some time before the economy recovers. So right now there is a definite disconnect between the equity markets and the economy, I think. But
Definitely.
a lot of that has to do with the unknown. We don't know what the economy is actually going to look at once everything opens up again.
Do you feel like they're willing to just print their way out of the market collapsing? Like, let's just inflate this thing until the dollar's worth nothing?
Yeah, and that's my fear. I think they are. That's my fear. I don't agree with that. I didn't think we should have done half the stimulus we did here. I think if they were going to, help here, I think most of the money should have gone to the individuals. I think, the things they're doing on one side of it, where people are able to defer mortgage payments, or they're getting those $1,200 in cash and that sort of. I think they should have done a lot more there rather than the bailouts with some of these companies. I think the bailouts are ridiculous. I thought they were ridiculous in 2008, and if companies aren't prepared for it, hey, that's part of business, right? If I load up my company with debt and business turns down, I'm going to have trouble surviving. It is what it is. And so I think they made the one mistake in 2008. They're doubling down on that now. Eventually, we have to pay the price, right? Eventually, things have to work out. And I think if they prevent the bigger downturn now, eventually we're going to have an even bigger one. So I would rather see this market, drop another 40% from here, get it over with, and then go on another sustained run higher. But I think if anything, if they're going to throw more money at this, I think it should be to the individuals and not these companies.
Crypto expert says, thank you for the course. Very generous. So.
Not a problem.
All right. On that note, Vince, it's good to see you. I'm glad you're healthy.
Same here.
And for everybody that came, thank you for coming. Hope you fully enjoyed it. Make sure to reach out to Vince at tradingwins.com, and we'll see you at the next one. Thank you, Vince.
Thanks for having me on, Jeff. Appreciate it.
Hey, everybody. Thanks for attending. Let me see if that mic level is not too high. Hey, thanks, everybody, for attending tonight. We want to say our thanks to Jeff Gibby and Vince Vora for doing a great presentation. I wanted to remind you that in just about, 4 hours from now, 8 o'clock Eastern, United States Eastern, we're going to have the APAC Summit, which will include the 7 presenters over the course of 7 hours. It's free. You can go right now to metastock.com and what am I trying to say? Register for it, or you can just come back here to YouTube in about 4 hours and just watch it here. So thank you so much, and everyone, successful trading.